Namaste and welcome to Progress Review of Budgetary Control. A budget is a tool which helps management in planning and control of both financial and non-financial resources. Budgets are classified on the basis of time, function, and flexibility. Three types of budgets. Budget period depends upon the type of budget, the nature of business, and the length of trade cycle. Principal budget factor, key factor, or limiting factor is one which over a period of time or at one point in time it limits the activities of an organization. It is the constraint. Budget relating to key factor is prepared ahead of other budgets. A budget that gives a summary of all functional budgets and a projected profit and loss account is called master budget. Budgetary control system aims at fixing responsibilities on executives through individual budgets. It's a tool which helps planning and control of financial and non-financial resources. Budgets are classified based on time, function, and flexibility. Budget period depends upon the type of budget, nature of business, and the length of trade cycle. Key factor, limiting factor, or budget factor is the one which at a point in time or over a period of time it limits the activities of an organization. Budget relating to key factor is prepared as the first priority ahead of other budgets. A budget that gives summary of all functional budgets and profit and loss account is called the master budget. Budgetary control system aims to fix responsibilities on executives by having individual budgets for delivery from them. Budgetary control facilitates introduction of standard costing gradually. When the level of activity fluctuates widely, fixed budgets will not be effective. We need to have an alternative. That is the flexible budget, which is prepared for more than one level of activity. A flexible budget is designed to change appropriately with fluctuation in output, turnover, or other variable factors. It reflects all the changes. Sales budget is the first budget to be prepared before production budget. Functional budget is prepared for a period and it is prepared for each and every function for the organization separately. It facilitates introduction of standard costing. Fixed budgets are not effective when the level of activity widely fluctuates. There the flexible budget becomes relevant for more than one level of activity. A flexible budget reflects changes or fluctuations in output, turnover, and variable factors. Sales budget comes always first before the production budget. Functional budget is prepared for a specific period and it is prepared separately for each and every function for the organization. Cash budget is a budget of cash income and cash expenditure, and it incorporates both revenue and capital items, and it covers the budget period. There are three principles which are used in preparing cash budget: accrual principle on an accrual basis, difference in capital and revenue items shown separately, and the principle of conservatism. Capital expenditure budget is a plan for capital expenditure expressed in money terms. Zero-based budgeting is a system where all activities are re-evaluated. When they are re-evaluated, past is not the basis, and the zero-based budgeting starts with an assumption that there is no requirement of funds, but every requirement has to be evaluated and justified afresh. And such type of budget is more relevant in discretionary cost areas. Example, research and development. Responsibility accounting is a system of accounting that segregates revenues and costs into areas of personal responsibility. It is accounted responsibility wise in order to assess performance of persons who were given the authority. Responsibility accounting follows the principle of authority holder to deliver on the budget. Cash budget is a budget of cash income and cash expenditure, both revenue and capital, for a budget period. Three principles: accrual principle, difference in capital and revenue items, conservatism. Capital expenditure budget is a plan for capital expenditure. Zero-based budget requires re-evaluation every time a demand is made, and it starts with the assumption there is no requirement of funds, and every requirement needs to be subject to evaluation. Zero-based budgeting is relevant to discretionary cost areas like research and development. Responsibility accounting segregates revenues and costs based on personal responsibility, which follows the person who was entrusted with the authority. Uniform costing is a technique of costing. It involves application and use of the same costing principles and procedures by different organizations under the same management, or it is used by members of an association of firms. Interfirm comparison is a technique of evaluation of performance of multiple entities. Transfer price is a notional value at which goods or services are transferred between divisions of an organization which is decentralized. Learning curve is essentially a measure of experience gained in production of an article by an individual or organization. As more units are produced, people involved become more efficient than before. Each subsequent unit takes fewer man-hours to produce. Experience gets reflected and reduces costs. The cost behavior of learning curve is called experience curve by Boston Consulting Group. Learning curve ratio is average labor cost of first 2 units divided by average labor cost of first unit. For example, if average labor cost of first unit is 100 and average labor cost of the first 2 units is 80 per unit, then it is known as 80% is the labor learning curve ratio. Uniform costing is a technique of costing, involves application and use of the same costing principles and procedures by different organizations under the same management or between members of an association of firms. Interfirm comparison is a technique of performance evaluation between firms. Transfer price is a notional price at which goods and services are transferred between divisions in a decentralized organization. Learning curve is a measure of experience gained in production of an article by an individual or an organization. As more units are produced, people become more efficient than before. Each subsequent unit takes fewer man-hours to produce and saves cost. Learning curve ratio equals average labor cost of first 2 units divided by average labor cost of first unit. Thank you so much. Thanks a lot.